Hi everybody, quick market update today. So the market's up pretty handily this year and it's led by the tech sector, specifically 6 or 7 stocks. Would you believe 6 or 7 stocks make up the vast majority of the entire return of the S&P 500 so far year to date? That means 494 stocks are essentially flat if you weight them all together. So the S&P weights their stocks based on size. The biggest stocks get the most weight. The Dow Jones, on the other hand, does not. So that's why the Dow is only up 2 or 3% year to date. So the takeaway is this is not a widespread market rally by any stretch of the imagination. And the story continues to be the Fed and its battle against inflation. So as we know, understanding the ramifications of the Fed's decisions and dissecting every little word that they throw out there can shed some light on where the market is headed. Recent statements just this week indicate that they will pause for now, but they're very much open to future rate hikes. They acknowledge that the labor market is still very strong and that inflation has come down from its peak, but they also emphasize that the committee is completely unified in their goal of getting inflation all the way down to that 2% target. Going from 9 to 4 took a little bit of time and a lot of effort. The reality is getting from 4 to 2, we don't know how long that's going to take, but it's probably not going to be as easy as you might think. For monetary policy to be tight enough to have an impact on inflation means it's going to have a strain on the economy as well. And up until this week, the market hadn't really been pricing in any hikes looking forward at all. So that explains a little bit of a pullback that we've seen the last few days. The market's starting to adjust its expectations. And, why wouldn't the market be buying into this? Well, if we do go into recession, the Fed wouldn't really need to cut any further. That would kind of take care of inflation, most likely. We were seeing turmoil in the banking industry. We've seen Silicon Valley Bank, First Republic, and others have caused smaller community banks to tighten their lending standards. That's not good for the economy. And we're also seeing a yield curve that isn't just inverted, it's more inverted than it's been in a long, long time. What I mean by that is an investor should demand a higher return the longer they go in committing their capital for a bond. Right now, investors are just as willing to accept a 3.6% return over 10 years as they are a one-year return of 5%. So that's not how a healthy market should function. That means there's a good chance we see a recession. So why stay invested? I'm going to bring up a chart here. Historically, if you wait, there's a period between when the market bottoms out and when a recession is declared. So this chart shows, hey, that time period has ranged between 8 months and 21 months, going back to the last 6 recessions, right? What has the market done in between those 2 times? So the market's actually done really well. If you look at the 4th column in the chart, the range of returns from the S&P has been anywhere from 28% to 94% during that lagging period. So it's important to remember that the market always trades in advance of what's coming, right? They're always going to trade ahead of the news. They don't trade on what's already happened. So stay disciplined, stick with it. If you have any thoughts or questions, don't hesitate to reach out here. We are here to help. Thanks.